Okay, I am Solomon Lederer, co-founder of Blockmatics, and today, um, so we're here with John Van Loo, who is going to be leading a panel, a crypto and blockchain panel that we're going to do in March. And this is a little bit of a preview. We're going to go through some tax issues in the crypto space. I know this is a very kind of fruitful, exciting area. So my understanding, so you're from a law firm, Belcher, Smolen Van Loo. You're a small firm out in the Valley. And my understanding is you started from sort of the representing private equity firms who were doing sales and acquisitions of, I guess, different companies, and you were helping them with the tax issues related to that. And then somehow you made a transition, I guess, by virtue of being in the Valley into the ICO space. Yeah, how did you first get started?
Yeah, that's right. I mean, my background is actually working for big firms. So my 3 different firms. The last one was I was focusing on private equity M&A transactions, and then I started out on my own. Opened my own shop in California and in the Bay Area, and my first client was a coin fund, actually.
Oh, really? Yeah. So we met them last night.
Met them last night, exactly.
And as I mentioned, we've gone back. Yeah, they've been involved, or we know them through Blockmatics as well, for going back a few years.
Right. And really from that point on, I kind of focused my tax practice on this space because it made sense combining both my background in financial services and wanting to tilt more towards tech.
Gotcha.
After opening my own practice, so it's worked out.
And I guess now you're more in the tech than you ever expected.
Yeah,
because we had a small conversation before, and we were talking about things like proof of stake and mining, which hopefully we'll get into soon. But yeah, it just sounds like you've really had to dive into this new field. I mean, this is going well beyond anything that you learned in law school, that's for sure.
Yeah, definitely.
So, but which is fun. I mean, we've seen that in all areas where somebody is coming from law enforcement, and now that they have to learn all about blockchain technology, or somebody is, I see a lot of lawyers in the legal side of things, which we also do a lot of events and discussions around law and blockchain, and obviously you're on the law tax side. So so let's just jump into it. I think we'll cover a few questions related to tax, which will be, again, as a bit of like a preview introduction for next month. So I guess the big discussion last year was around like-kind exchanges for crypto and how that's taxed and whether or not that is even something that's doable. So maybe give a little bit of a recap of what that is, and then I know there was a big debate whether or not you can even do that for crypto, but now something has changed for the 2018 tax year where that's no longer. But anyway, I'll let you kind of
that's all correct. And I think it's understandable that this is such a big issue for this sector because if we just step back for a second, the common sense understanding of what happens when you, for example, are trading a Bitcoin for Ether or using Ether to participate in an ICO, for example. That's maybe the most common kind of use case, I guess, of transfers of cryptocurrency. It's not obvious that would be a taxable event.
Gotcha.
It's not a common sense kind of something that would occur to someone who isn't a tax professional or hasn't kind of educated themselves on these issues. So I think it's perfectly understandable that it's an important topic, something people are thinking about. And so from a tax perspective, the IRS issued a notice clarifying that they viewed transactions in cryptocurrencies as taxable, at least when you're you're transacting in cash for
Okay.
for cryptocurrency.
So, right. So obviously on the side of buying it, but I guess to pick up on the point that you're saying, a lot of people thought that's not a taxable event. So for instance, last year there was a big ICO by the EOS blockchain, just to pick one. And in that one, people were just sending, they only raised money through crypto, through Ether. So you can only send Ether to a smart contract, and then you would get back these EOS tokens. So I guess I could see why people would think, oh, well, I am now just interacting with this, software on the blockchain. I'm just sending in some of these digital coins, and they get kind of converted into these other ones. And why is that taxable? I'm just sort of morphing one into another. But obviously, that is you are really changing the asset that you're holding, or that would be considered that you are selling the Ether.
Potentially,
right?
yes. Potentially, it's a taxable event because you're selling one type of property for another type of property, and those transactions are generally taxable. But that brings us to what used to be. We start with what the old law before January 1st, 2018, which was that certain types of property transfers were not taxable.
Right. So that was the if
That's
there's
a
similar to 1031 like kind, that if that is so what is I guess a place where it was designed for, what it's definitely applicable for, versus now that the IRS has come out and said explicitly that it's not cannot be applied to cryptocurrency exchanges.
Yeah. So, well, first of all, it was actually changing law, so it wasn't the IRS; it was Congress. But before we get to that, under the old law, the 1031 exchanges were most common in the real estate context. So that was kind of the most frequent, most common way that people would, especially commercial property, you would transfer one type of commercial property for another, and that could be not taxable. But it also applied to, especially in the business context. So, for example, trading players, sports teams, trading players, or even franchises or things like that. And it also applied in the context of intangible assets. So businesses swapping, like, for example, telecommunication spectrums on the radio wave, things like that.
So even if certain spectrums maybe had a certain sale market value of some price. So yeah, it would not, even though I guess like certain spectrums would
radio for TV, for example. That was one.
Like
I'll trade my radio frequencies for your TV frequencies.
Interesting. So even though the price of, let's say, those frequencies may be appreciated over time, where like in 2018 it was valued a lot more than in, say, 1990, nevertheless, by you swapping that to some other, from radio to TV, it's still a like kind, which is interesting because that sounds like a pretty big jump, almost as big, if not more, than switching from, let's say, Ether to EOS tokens. So what was the change of law? Like, what did they come out and say with respect to? You said it was the congressional.
It's a change in law. And then let me also clarify that I agree that's a surprising result, but in the context of commodities, so things like gold and silver, the IRS has been much more strict. So you can't swap gold for silver. You can only swap certain types of coins for other. Basically, if the coin is valued based on the volume of gold, the volume and quality of gold, then you can swap. But if it has some kind of historical value, you can't swap. Things like that. They've been much more. So we don't really know where they're going to view these coins. Are they going to view this as more like this kind of business intangible property, where they've been very lenient, or are they going to view it as more like a commodity, a physical commodity? where they've been much more strict. So that's kind of
Right.
like, so that's the old law.
Mm-hmm.
And then what happened with the tax reform, the 2017 tax reform, is they eliminated all like-kind exchange except for real estate.
Gotcha.
So now
I see.
now it's clear that
Even the Spectrum stuff now is
right.
is
Right.
also-
Everything.
Okay,
You
so
know,
it
the
wasn't
sports
just
team
a
and everything.
crypto.
Yeah.
And what other sort of I believe there's some other bills like it's still there's a lot of unclarity in terms of or kind of it's not really clear about how cryptocurrency should be treated. So are there other bills currently in progress or in terms of how crypto should be treated or how this is going to change, maybe for the next tax year?
Yeah. So there have been a couple pieces of draft legislation that have been introduced in Congress that would allow tax-free like-kind exchange of cryptocurrency, which I think is very sensible. I mean, I think right now there's still a lot of ambivalence in Washington about how much they want to promote the sector, how much they want to crack down and kind of enforce rules.
I see.
But I think to the extent that they decide, yes, they want to promote the sector, they want to facilitate, this would be one of the most logical kind of rules that they would probably enact.
I see. So it's a no-go for 2018, probably for 2019 as well. I don't know how quickly.
At least for now. Yeah.
But there are a couple bills proposed to sort of explicitly allow like-kind for crypto.
That's right.
Gotcha. Who actually brings forward? So are these just certain Congress people that?
Certain Congress people. Yeah.
Okay.
One was a Republican. I think the other may have been bipartisan. I'm not exactly sure. Yeah.
All right, we got to find out who they are and write them, support them, and say how much. Yeah. So you're right.
I think a bipartisan, obviously, that would be a lot more likely.
Yeah.
And I would think there's a chance. I mean, I think that there are. It doesn't seem like this is a particularly partisan issue.
Right.
At least I don't think. So
yeah, and you could definitely see both sides kind of trying to make at least to simplify things. Nobody wants to add extra confusion or complexity.
Right.
Taxes.
And as well as for the IRS, I think the IRS is so overwhelmed right now. I think it would actually help them as well. To be honest, I mean, trying to go through an audit where someone has done a large volume of transactions is going to be almost impossible.
Right. Well, especially who knows if they'll still even be up and running from tax time with this shutdown. So talking about, let's say, other so 2018 was a pretty bad year for crypto. It's gone down quite a bit, and towards the end of the year, a lot of people are trying to take some measures to minimize or eliminate any tax burden by sort of taking losses or at least exchanging out of coins that they've actually potentially profited from. And maybe this is something that's already not something our audience could take advantage of anymore because that's more of an end of year tax advice. Although I do want to ask you if there's some kind of workaround. So what I'm talking about is, say at the beginning of 2018, the price of Bitcoin and Ether was shooting up. This is maybe back in January, and maybe somebody transferred their Bitcoin into Ether. Like Bitcoin, I don't know, was $18,000, and they're like, what, Ethereum is 1,300. I think Ether's going to go up more. They go from Bitcoin to Ether. Now that is a taxable event, as we were saying. There's no
potentially, yes.
Right. Well,
for the lifetime, if they did it in 2018.
For 2018, I'm saying, the beginning of 2018. This is January. So that's a sale where potentially they've made a lot of money on that Bitcoin sale because maybe they bought it at 1,000 and now selling it at 18,000. They get that Ether. Now the price of Ether has gone down to 100 something, 120 now, I believe. So they've actually lost money, but they're still have to pay that $17,000 gain they got from Bitcoin. So I guess the sensible thing was at the end of 2018 to sell that ether, so you have that loss to counteract the Bitcoin gain. Right now, if somebody, number one, I guess the question is, if somebody didn't do that, is there any recourse even now to sort of fix for that or to?
No,
No,
I don't think
you're
so.
stuck with that.
can't see
Okay,
it.
sorry to bring that up because that's bad news. Are there any other rules around? I know we spoke briefly in terms of doing. I mean, I guess would you explain like what a wash sale is and kind of what the rules are around that and how or whether or not that applies to crypto?
Yeah, it's another kind of important topic people like to, especially last year. Obviously people wanted to harvest their losses, get some kind of at least tax benefit from the fall in prices, and there are a set of rules called the wash sale rules that apply to stock and securities.
Mm-hmm.
And what these rules are intended to do is to stop people from trying to selectively trigger tax losses without gains, just for a tax benefit. And so they require that in case of a loss, you can't buy the same or substantially similar stock or security in 30 days after your loss is triggered within a 30-day period.
Okay.
And so
if you sold, let's say, your Amazon stock at the end of the year to take that as a loss, you can't then rebuy it the next day.
That's right.
Right, because
Right.
you literally like it just to require that you actually are selling it, that you're not just selling it for a minute to get that tax benefit, and then at the end, 5 minutes later, you're actually back holding the same assets that you did, 5 minutes prior.
Yeah, exactly. Yeah. Or even an option, or
Mhm.
something substantially similar. You can't buy that either.
Okay.
For a 30-day period, and that 30-day period is considered to be long enough that you have taken on enough risk for a change in price that you can go then reacquire.
But in the crypto space, like 30 days is like 30 seconds should be the equivalent of 30 days.
Well, the question really is whether it applies to crypto at all.
Right.
Because,
yeah. So that's the question. Yeah.
Yeah, because the tax code has a number of different definitions of stock and securities or marketable securities. There are probably, I don't know, maybe 5 or maybe even more different definitions depending on the purpose of the statute. And in this case, it's a pretty narrow definition.
Mm-hmm.
In some cases, the definition is really based on whether you can get a market price, you can get any kind of a price for something. In this case, it's more narrow than that. It's really based on basically enumerating things like bonds, notes, stock, things like that. And so people have taken the view, at least practitioners have taken the view, that it likely doesn't apply to cryptocurrency.
Interesting. So you're saying that 5 specific assets or I don't know what you call them, securities that it applies to.
Securities, yeah, debt and equity of a corporation or some kind of business organization.
So general view doesn't apply to crypto. So that's good news. So I guess the good news we can say is that if 2019 is a bad year as well, maybe that's not good news, but then if you are selling crypto to take losses, you do have the ability to just rebuy them a minute later.
Right.
And that would not be considered sort of like I guess violated or a wash sale.
Right, it would be considered a wash sale. I think particularly for crypto trades, I think it could be helpful because then you're not exposing yourself, to some kind of phantom income. If the price goes down, you can at least, claim the loss at the end of the year and have that offset any kind of a gain you had earlier. That's right.
All right. Okay, cool. That's good. So I want to just switch gears and we'll talk a few minutes about another, I guess, pretty prevalent area in crypto, and that is not with buying and selling, but rather when you are earning tokens or generating the tokens. So both with respect to mining coins, and then also whether you are sort of gaining new ones with these newer proof of stake protocols. So which I believe with proof of stake that would apply more generally or become a lot more common for people to participate in, versus mining is a lot harder to get into. And I'm sure a lot of our audience, probably a very small faction, are on the mining side. But maybe just to give the full context here and the full picture, maybe we should just talk a minute in terms of how mining differs from just outright buying it. So is there any difference between, say, if I earn a Bitcoin just through my computer machines? So with mining, you just have the hardware, essentially. The computers are generating new coins every 10 minutes in the Bitcoin network. Somebody is awarded currently 12.5 new Bitcoins, and that maybe gets split out among a lot of other, if it's part of a pool that is mining it, it might be distributed. So how would that be? How would that differ from me outright buying a Bitcoin?
Sure. So one of the relatively few areas of clarity that we know for sure is that mining a Bitcoin is ordinary income for U.S. tax purposes. So that's not actually all that bad, because it can potentially mean it may be easier to claim losses and expenses against the income when you're generating the.
Gotcha. So you would just claim whatever expenses against that income. So is it just like an outright? Well, I figure out my electricity bill, what I paid on the hardware, and just subtract that from the earned Bitcoin.
Right.
Okay,
But then what it does do is it creates a need to have some kind of cash to cover your tax liability. When you generate the Bitcoin, because you're going to have to pay cash. As soon as you mine that Bitcoin, you're going to have to pay some kind of cash tax.
Interesting. So and I believe actually our panel last year talked about this, but I guess I don't quite remember what they all agreed on. But I think they were saying the same that you're saying, is that it's a taxable event at the time the Bitcoin is mined.
That's right.
So if the time I mined it, Bitcoin is $5,000, but I don't actually end up selling it until it's 4,000, that doesn't matter.
That's right.
That would be. I guess I can claim that separately as a loss, perhaps at some point, or if I sell or.
Well, and this is actually where this is the disadvantage of having the ordinary income, is that the loss on the sale of the Bitcoin is going to be capital and can't actually be used against the income. So
why? I'm just wondering though, why is that considered ordinary income versus, if someone mines the Bitcoin, it's a $5,000 Bitcoin, versus somebody that buys a $5,000 Bitcoin, they only get taxed as that goes up or down only when they sell it. But if I generate it, and even though I sell it at 4,000, I'm trying to understand exactly what the distinction is.
A more favorable rule would obviously be that the Bitcoin isn't taxable until you cash it out,
right,
or trade it for another coin, something like that. But the IRS decided that isn't what the law is right now.
Mm-hmm.
And the reason they said that it is it's ordinary is because they thought that this is more like a business activity, having doing some work, like you're doing some work.
That makes sense.
Yeah.
So that's maybe a good way to get into sort of the other side of this, which is with proof of stake rewards, or proof of stake mining. So in proof of stake networks, those new coins are issued to those who already hold coins, and for the most part, the holders of, or those that have stake in the network, they're not really doing much work. I mean, you do have to run a node on your computer, so you are just running the program, but it's very lightweight. You don't have to do any kind of real investment in hardware. It can just run on generally on any laptop. There's no added electricity costs really, because other than just keeping your computer on all the time, 24/7. I don't know, maybe you have some people that run it on some like AWS, like Amazon server. Again, their costs are minimal. But say you start out the month with 1,000 coins, maybe at the end of the month you have now 1,003 coins. So I guess the question is, those coins, when are those, would that be taxed similarly?
The staking is a tough one. I think the easy answer is, I think it's ordinary.
Mhm.
And I say I think because the IRS hasn't actually said, but I wouldn't bet on them saying anything different.
Okay.
I think it's unlikely. It would really take Congress to come in and say, and I don't think Congress would do that either. I just don't.
Right.
That doesn't strike me as a very pressing kind of issue, for that Congress would feel they would need to. I think they're a little more concerned about having people being kind of crushed
Mhm.
by having to keep track of a bunch of smaller transactions.
That is a big problem.
Yeah,
Too.
yeah. I agree, and that's that's why I don't think any kind of legislation would really address mining, or staking. I don't think it's going to give any kind of relief to stakers.
It's not.
So, but so I think it's ordinary, just
Mhm.
like mining.
Right.
But a
So
bigger
you would have to
question.
keep track then every, let's say, day. I don't know. I mean, potentially.
Well,
You're
the
earning
timing,
some-
the timing is that's the harder question. I don't think that's so clear. Like, for example, I know in some cases, you're potentially penalized, right, by claiming
Mhm.
the coins that you have earned through your staking. You can't actually sell them immediately.
That's
They're tied
another
up.
thing, right?
Right.
Generally, often there's even some delay period until you're able to withdraw it. So I guess at the very least, you can't get taxed on the stuff that you don't really have access to even pull it out. But like you say, there's a lot of these proof of stake networks. They're also dependent on you having, you still have to keep some kind of deposit there for some even longer period of time, and that's almost like it's like an insurance mechanism that can penalize you later if it's determined you're producing, I don't know, bad blocks on the network. Then your stake can be revoked. I mean, I know the Tezos blockchain works this way. So even
As
though
well as
you have,
incentivizing people. I mean, maybe that's more of a side thing, but it also kind of incentivizes people to may remain invested in.
definitely,
Yeah.
right, and it definitely cuts back on people. It not only incentivizes them to participate in the network, but it also reduces people just speculating day to day and
Right,
trying to
right.
push the price, remove it. It's like, no, it's like if you're using the coins to stake, they're kind of stuck there for a while. I think
Right.
it's something like 5 weeks or 6 weeks.
Right. Right.
Yeah.
So I think that's an area where you could potentially, use a reasonable method to say, look, I'm not taxed immediately because I just there's no liquidity. I don't have any liquidity. I don't have access.
Mhm.
It's a more factual question. It's more question about what a timing, what's a reasonable method of
Right.
taking into account your earned points.
Gotcha. Is there any I'm just wondering, like, I guess we'll end maybe with this kind of philosophical notion on this, is that you can make the argument that with proof of stake, as more coins get issued to a network, it's sort of, you're increasing the supply, which presumably has some kind of downward pressure on the price. So like all of your, if you have this sort of closed system, there's, let's say, 1 billion coins, and now that billion coins over the course of the year turns into 1 billion, like maybe let's say it turns into 1.1 billion coins. So presumably that would have like a adverse, maybe like a 10% negative effect on the price. So on the proof of stake coins, I'm earning that, let's say 10% more coins. Presumably you have to pay tax on that immediately, even though my other, let's say the other 90% have now declined in value, and I'm not getting the benefit, or I'm not offsetting that.
Yeah, no, it's a good point. It's a good point. I mean, I in that kind of a situation, maybe it makes sense to allow people to just make an election at the end of the tax year to say, it's called right now there is something called a mark-to-market election, but it's restricted to only certain types of taxpayers. You have to qualify for it. So maybe one solution would be to sort of make that election more widely available, just so people don't, they can just say, okay, what's my portfolio worth on December 31st, and just pay the difference, or take a loss or gain depending on where it is. I mean, that would certainly simplify things. You just take a snapshot of your portfolio on that day.
But you're saying there's some kind of process in order to be qualified?
Yeah, it's generally only allowed for traders, and you have to be very frequent trader to qualify for that.
I guess at the end of the day, this is still a very complicated area. So, especially for anyone who is mining or staking. And I do think, like I was saying, that staking will be a lot more pervasive going forward, because you don't need this initial investment. So, I mean, they're pretty small now, these proof of stake blockchains, but Ethereum is on the way to make that change, and that presumably all Ether holders, if you have Ether, like in maybe a year or two, your Ether is going to be generating new Ether coins, and then you have to sort of track those and pay taxes on it accordingly. So, okay, I guess it's a lot to talk about. You're actually going to be the one asking the questions the next time around. So I'm looking forward to it. So that will be here in New York on March 6th. So yes, sign up through blockmatics.io. Also go to our website, blockmatics.io, to follow, read different articles that we're putting out on the cryptocurrency space. We have courses there. Follow us on Twitter, newsletter, all that good stuff. Thanks again, John, for coming out. And I guess for anyone, I mean, I know you work just internationally. You take on clients all over. Is that right? Or at least nationally? So
yeah. I mean, I have clients, particularly focused in kind of New York and California. But yeah, I have clients across the country, and sometimes even internationally. Yeah.
Okay, so Belcher, Smolen, and Van Loo. That's you. You're the Van Loo guy. Yeah, but we'll actually have the links up to your site as well in the notes to this video. Thanks again.
Yeah, thank you.
Yeah. Bye, everyone. Until next time.
Bye.